presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone, and welcome to the Compak Asset Management YouTube update for June the 4th, 2021. I'm Moe Ansari, President of Compak Asset Management and host of Market Wrap. By the way, don't forget to subscribe to all of these. All you have to do is click on each one of those. You'll be subscribed to this YouTube, and whenever I do an update, you will be notified, so don't forget to do that. Next Wednesday, I'm going to do the first summer webinar, summer kickoff webinar where we will take a look what has happened so far this year to the economy, to the markets, where we expect to go for the second half of this year, a global economic update. We will talk about all of that and then also take a look at technically where do we stand. Will the Fed raise rates? When are they going to start to taper? What about tax increases? How much of the infrastructure spend will ever get passed, if it ever does, in Congress? And how will all of this impact the markets and you? All of that on the 9th in the evening, and I will try to answer as many questions as I can. That's next Wednesday, June 9th, 6 p.m. Pacific time. All you have to do is click on the link below and you can register. It is absolutely free. I'm going to talk today about the markets. We'll do a quick recovery update. What has happened to COVID? It's sort of fading into the background. Thank God for that. And then we'll take a look at the technicals. The big news in the economy was today. We had unemployment data come in at 559,000 jobs created in May. The number expected was 671. That was the number that was the expectation. So this number is slightly lower than expected. But it wasn't this as bad as everybody thought. And some people who said last month people were looking for 1 million jobs created. This month the whisper number was a lot higher. So coming in a little bit lower really takes the pressure off the Fed. The Fed does not have to raise interest rates. The economy is not overheating. All the people that were running around saying, oh my God, inflation is coming, all of a sudden saying, wait a minute, the economy now is plateauing. It might not grow as fast as everybody was thinking, and it might plateau. I think we're growing at a nice, reasonable pace. That's what is expected coming out of a very deep hole that we were in during the recession and the COVID pandemic. But we're coming out of it, and as we do, we're gaining momentum, but the numbers are not overly hot, as I would put it. We do get to next week the CPI and the PPI numbers. They will come out a little bit higher than expected, but that is, I think, it's the bulge that is passing through right now. And as we get through, everybody coming out of COVID, doing the things that they have not been able to do for the last year and a half, and then we settle into a normal pre-COVID routine. But the first 3 or 4 months coming out of COVID, I think everybody is trying to do everything. But once we settle into a normal routine, the kids go back to school in the fall, all the schools reopen, I think we're going to plateau, and that'll take away any pressure for the Fed to raise interest rates, and that'll take all the inflation talk also out of the economy. What will that mean for the market? I'll talk a lot more about that on June the 9th, so don't forget to tune into that webinar. And the unemployment fell from 6.1 to 5 in May. Mainly we saw growth in leisure and hospitality. Everybody is starting to travel, and we are starting to see the travel numbers. Some of this past weekend were the best we've seen since the COVID started. And the Fed is talking about the pace of reduction of bond buying program or the taper. I don't think that that's really relevant until the end of this year. Well, they'll start talking about tapering, and then they will do the taper. And there's no question that they're not thinking about raising interest rates until 2024. It's when they start tapering. What does tapering mean? It means they're going to buy less bonds. They're buying $120 billion worth of bonds right now every month. They might cut that back to $100 billion, $80 billion, gradually slow that down as the economy starts to stand on its own 2 feet. Looking at some of the, look at the PE ratios on some of these stocks. I was looking at different sectors. Here's 40 to 1. You're looking at some of the other ones, 90 to 1. You're looking at CMG, which is around 50. You're looking at S&P around 21. It has come down, so it's at 21. So you're seeing all of these reopening stocks have already gone up a lot. That's what you have to remember. Everybody's saying, oh, you should buy the reopening stocks. They've already moved. If you wanted to buy reopening stocks, you had to buy them in November or October of last year. What you want to have is a balanced portfolio, so you're not running from one side of the boat to the other side of the boat. Oh, it's reopening today. Oh, it's back to technology today. It's reopening, technology. Don't, and trying to adjust your portfolio, you just go round and around in circles. Having that balanced portfolio, which you can handle the ups and downs, having some of the reopening stocks, enough technology stocks, some of the energy stocks, which were the worst performing sector last year, they're the best performing sector this year. So having that balance is what gets you from where you are now to where you want to go financially. Looking at, again, some of these ratios, you look at compared to the S&P, which is right here in white. That's what we've seen, the gain right there. But you're seeing some of them are still below the S&P and do have some opportunities there. Everybody is also very concerned about what is going to happen with taxes. Are the taxes going up? And what happens if capital gains go up? Will they kill the stock market? Well, let's take a look. 6 months before the tax hike, everybody's concerned. Market sort of gets a little wobbly. People get shaky. After 6 months after, you can see what happens. Return on the S&P. Market does not crash. So, oh, we can handle this. It's okay. And market goes up. You look at the PE change prior to the increase, after the increase. You see 6 months prior, household equity allocations. People are worried about not buying stocks, then they buy stocks. Momentum, which is negative going into when everybody's talking about tax increases and after tax increases. So what this all boils down to is if we do get some capital tax increases on people who do make over $1 million, I don't think it has an impact. If we do get a tax increase on some of the other, like corporate taxes from 21 to 25, I don't think it has any big impact. But what happens if we change the stepped up basis? That could have a big impact. I'll talk about it again on the webinar on Wednesday, June 9th. Don't forget to register for the webinar. Let's take a look at the recovery. We are 300 million people, nearly doses administered. We're looking at Moderna. We're looking at just about everybody that wants to get vaccinated, can get vaccinated. We need to get as many people as quickly vaccinated. Israel is the most vaccinated country, United Kingdom, and we are right behind the UK. So we are all doing we have come to about 50%, and we should get to herd immunity in the next couple of months, and that will set us at ease. That does not mean people will not get sick. People who have not been vaccinated are going to get the virus. You're going to get the virus or the vaccine, either one of the two. People are making that decision which one they want. Unfortunately, if they're young, it's like the flu. It's no big deal. But unfortunately, for some people, even they're young, they end up in the hospital, and that's something that they should be concerned about. But as we get to herd immunity, we're reopening, and I believe in the next few weeks we should be totally reopened. If you look at the reopening index, we're at 81. This is the highest since the pandemic. That was last year, and now you can see we're at the highest level since the pandemic. We are not back to the pre-pandemic level, and if you look at the reopening scale, it is up to 7. It was 6 last week. So we are getting there. I think in the next few weeks we should be totally open. If you look at the tracker, initial jobless claims, 2019 level, 218. We're still higher at 406, but it's not the million jobs lost and anything like that. You're looking at hotel occupancy. It was 71, and we're back up to 60%. So we're just about 10% lower in hotel occupancy. You look at TSA, we were over, this number is as of May 31st, 1.7. So we're still down from 2.4, but we are getting up to that 2 million mark, which is about what is expected. So I think we're just coming up, and we are reopening, and we should be reopened in the next couple of weeks. Markets are back up to 42.35 is the number that I pointed out in the last webinar. The high that we've seen is 42.32. That's the highest close in the S&P ever. We closed today at 42.29. just within an eyelash of an all-time high. If you do break out above this, we've sort of came down off of it, tested the 50-day moving average twice last month, and now we've sort of come back up. If we do break out, next level is somewhere around 4,400. That's been my target all year. Will we get there? As I said in March, that we go into the end of May, then or get into the end of April, then in May we go sideways, which we have seen. Everybody starts to worry about inflation. Then we sort of maybe break out a little bit. And if we do break out here, do get above 42.35, we might go up here and then come back down for the summer doldrums. I think we could get new all-time highs and then a back off from it, but that's what we're looking at. From a long-term perspective, 44.75, each one of these lines is 1 week of trading. In the previous chart, it was 1 day of trading. Support 41.61, 39.5, 3800, and 33.46. On the previous chart, I showed you support is around 41.36. That's the 50-day moving average that we're looking at. Nasdaq had a really good day, but still we are way below the 14,211 all-time high. We're not way below, but about 13.8 was the close today. That's where we closed 13,814. We're starting after we see everything moves in 5 wave. This was the 5th wave top right here. Then we went through an A, B, C correction. That's what we go through. But now we're starting a new wave count. This is wave 1, wave 2, wave 3. If we break out to new highs, target becomes 14.4 to 14.8, 14.750 on the Nasdaq. I think if we do break out on the Nasdaq, the S&P and the Dow will follow. On the weekly charts, again, we're looking pretty good. Over here, we came and tested the 20-week moving average. Support is at 13,000, then 12,340. We do break out above these highs that we made last month. Long-term target, 16,400. Doesn't mean it has to go there. These are my views. These are my interpretations of the way I'm looking at the charts right now. But you saw what we talked about 3 months ago, what has happened so far, and where we're headed next. That's the way I'm looking at the charts right now. Gold popped up above the 200-day moving average, made a nice move here, wave 3 to the upside. We're looking like we're starting wave 4. Support is at 1850, which is a 200-day, then around 1800, which is the 50-day moving average. Resistance is right here, this double top we made in January and November of last year. January of this year, which is around 1960. And if we can get above 1960, then we're looking at about 22,000 and about this all-time high of 2080 or 2100. Again, one of the things, when interest rates go up, that takes away the glitter of the gold market. Today, with the numbers coming out not as hot, the unemployment numbers taking the pressure off the Fed, we saw rates come down, and gold had a good day. It was up about $20 this week. It did not wipe out all the gains from earlier on this week, but interest rates are what is driving gold, not inflation. Usually it's inflationary pressure that drives gold, but it's the interest rates that are really driving. In the emerging markets, seems like we broke out above the 50-day moving average. Target is around 58, long-term target around 62, or even higher as 64. As the vaccine gets more available around the world, we are the first ones to getting it here in the United States. Europeans bungled it. They're about 3 months behind. And then once everybody in Europe and the Western world gets vaccinated, then I think we're going to spread the vaccine around the emerging markets, and they will be, by the end of this year, catching up. And that's why I think emerging markets are about 3, 4, 5, 6 months away. It's like buying reopening stocks 6 months ago. That's what the emerging markets look like right now. Russell is stuck in this range between 2,300 and about 2,100. We're going just back and forth, and we've been doing that since February. If we can break out about 2,360, we can get up to about 2,400. This is the small cap index, the Russell small cap index. That's what this chart is showing. But it's, as you can see, in a broad basing pattern, if we can break out of it, people are saying that's a reopening stocks, a small cap. Yes, and it sort of took off, but since February has gone nowhere. Here's the long-term chart. Here's the 20-week moving average, which is around 2242. If we can break out above 2300, which is the high that we made, we have a target of about 2425. Again, Don't forget, that's the technical view. Those are my views. Those are my observations, the way I am looking at the charts. Markets do what they want to. That's why you have a diversified portfolio. How do you develop that diversified portfolio? How do you get from point A to point B? How do you develop that roadmap to create wealth? I'll talk about all of that at the next webinar on Wednesday. That's the evening of the 9th at 6 p.m. You can just click on the link below to register. It's absolutely free. Learn before you do any investing. Those are my views. That's what I'm thinking about the markets today. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.